what we've covered to date, let's just go ahead and skip down to that slide. If you don't know us, I'm the Director of Investor Relations and Operations here at Goodegg. And my job is to make sure that you guys understand what you're investing in. So what we have got here, like I said, we're waiting on Damien. He's solving some technical issues on his end. Hopefully we can get him in here to chat with us. If not, I will reschedule that session for you. But what I get to do every single day is talk to you guys, you amazing investors, and help you guys navigate the ins and outs of passive investing, connecting to the deal, and helping you guys put your hard-earned money to work for you. So I've been working on this series for the past few weeks, and in this series we've covered a lot of topics. So we've covered the 4 tenets of conservative investing. We've also talked about the 3 secrets to control on how you as the investor can control the deal in a passive syndication. Right? We've also talked about a 5-minute quick underwriting tool. We've talked through the 3 different returns of passive investing. We've demystified the capital stack. We've understood the risk of passive investing. And then we also understood the 13 ways that we can mitigate those risks. And then we dove in a couple weeks ago about the tax factors, and then also tackled 3 different ways that you can fund your deal. So in this week, we were hoping to get Damien on so we could talk about how we could move your money or repurpose your money from a retirement account into an EQRP and kind of blow apart or actually save you guys a considerable amount of money by avoiding different taxes that can actually be charged in a retirement account. I know that's kind of like mind-blowing. You invest passively with your retirement account and you can actually get charged taxes, okay? He's the expert, I'm not, but I'm happy to start answering any questions here in a couple minutes. But jump in that chat box. We have a great opportunity right now to catch up on all this stuff. If you haven't listened to the previous webinars, let's make this kind of an open Q&A session and just kind of work through the different topics we have tackled to date, and we can dive into math and examples and just kind of take it from there. So who would like to jump in the chat box and give me their first question that you're dying to ask? All right. Are there prior episodes of the series available somewhere to view? Yes, they are on YouTube. There's a playlist. I will send out just a recap email. There won't be a replay of this one, but I will send out a recap email, and then I'll have a link to those episodes. If you've been, I've been sending out that recap list every single week. So that is available for you to take advantage of, for sure. All right, a couple of people just joined. I just let them in. So just the guys let you know, we ran into some technical difficulties with getting Damien on the webinar today. And so we are, until we can get him in, we are doing just kind of a Q&A recap live. So find that chat box. These are the things that we've covered in the series to date. And I am answering questions live. We can go as high level or as deep as you guys want. Next question that came in. Can you do QRPs for W-2 employees who are on H-1B visas? Great question. I do not know the answer to that. So what a QRP is a qualified retirement plan. So what I can give you is that it takes advantage of the ERISA code. So that's the code that triggered the creation of the 401k, which is the retirement plans that employees were able to set up. Originally, when the 401k was set up, it was set up actually as a income deferral plan for high income earners. It was never meant to be a retirement account. Okay, so but employers, you can read. There's some fascinating history on this, and you can read through that history. And what it tells you is that, again, this was meant to be an income deferral plan. So if you were a high income earner, you could actually defer your income into later years. But the QRP is actually a qualified retirement plan. It is a deferral plan, but you get to sock away so much more money. So last time I contributed to an IRA or Roth, I could actually only put away like $6,000 or $5,000 a year if I were investing or contributing to it personally. It was a combo of $19,500 if I was going through my employer. Certain types of self-directed accounts, you can actually, and specifically with the QRP, you could do up to $56,000 and potentially have your spouse contribute too, which can actually bump up your deferral to over $100,000 annually, which is huge, very huge. So can you do that with an H-1B visa? I don't know. We would have to definitely bring an expert on that to make sure that we got that question answered for you. All right, switching gears. What are the three ways to fund your deal? Okay, awesome. So the 3 ways to fund your deal is you can actually invest individually. Okay, so you're putting in your own particular cash into the investment. You can actually invest jointly with a spouse. Okay, there are certain states that actually have communal property laws to where we actually have to, even if somebody is investing individually, they technically are investing jointly, say like California, because of the communal property laws. And then you can also invest with your retirement or with an entity. So I very specifically say entity because it could be a trust, it could be a business, it could also be like a retirement account, like a self-directed account or a QRP. Okay, so there are some advantages and disadvantages to investing in all those different ways. And actually it depends on what you're trying to achieve. When we are looking at how you're going to invest in those 3 different ways, the questions that I like framing around that are what kind of asset protection do you need? Okay, and how do you want to determine your heirship? Okay, if you have any sort of asset protection, or want asset protection, you might want to think an entity. If you want to have your heirship determined, you determine your heirship and not the state determine your heirship or your will, then you might want to invest through an entity as well. Entities might be a little bit easier for you to kind of, pass heirship between, say, like a spouse to children or to like a nonprofit. So those are just some different ways to think about. The other consideration on how you fund is also, do you need the cash now or later, right? So if you need the cash in hand now, or the distributions now, or if you want to take the capital gains and spend that now, then investing as an individual or joint might be the best option for you. If you want it later, maybe an entity. And again, a trust or a business, you might be able to take all that now, but with a retirement account, if you're investing as an entity with a retirement account, obviously all the distributions, all of the capital gains go back to that retirement account. So again, those are just the 3 different ways that I would that kind of filter through how you would want to, figure out how you want to fund your investment. All right. What is the process for investing through a whole life policy? That's very interesting. I have a whole life policy. What I would do is I would just take a loan against the whole life policy. And if somebody doesn't understand what a whole life policy is or how it could work for an investment, drop that in there. I'm happy to kind of go down this rabbit hole because I think it's so cool. But you would just take a loan against the policy. Okay, so email your provider, whatever that loan process is. Probably takes them 2, 3, 4 days to get the money into your account, and then you would invest as an individual or joint or entity. Then you would be able to kind of move that cash however you wanted and then invest. All right. Just remember that at some point in time, you might want to consider paying back that loan, right? You're not taking cash out of the whole life policy. You are taking a loan against the policy. The policy is the collateral. And so unless you don't want your death benefit to be reduced, you would want to pay that loan back at some point in time. All right. When we get K1s from our syndications done with our self-directed IRAs, we are supposed to forward those to our custodians, or are we supposed to keep them for our taxes? Great question. The follow-up to that was, my CPA says I need a 1099-R for my custodian, but my custodian doesn't have one for me. Clarifying question there, Kara. What type is self-directed? Is it a self-directed IRA, Roth, or a QRP? And are you investing, is your IRA invested directly, or is it invested through what we call a checkbook IRA, meaning you set up an LLC and then the LLC invested for you? That would be some clarifying questions for you to consider, okay? Invested directly, Roth, and traditional IRAs. Okay, so yes, you aren't going to get a 1099-R because they aren't dividends. You're actually, when you invest in a syndication, you're investing in a business. So the business is a K-1 return. And that your CPA should be able to handle the K-1s, and they probably would need to understand that what you're trying to do. In theory, you would just hold on to those. In my personal situation, my CPA just says, hey, file those away. He actually keeps a copy of them on my behalf for when the asset sells. But other than that, like, we don't submit those. But again, I'm going to defer to your CPA because, here we are not financial, tax, or legal advisors. And so we don't know your exact situation. So definitely I would defer to your CPA. But I would dig a little bit deeper with your CPA and see if they can't pull more information off that K-1. On most K-1s, you're going to get a statement that falls behind the K-1. So the K-1's just the tax document, and then there's like probably another 6, 7, 8 pages of all the ins and out of the business as far as the income and expenses and how everything flowed. See if you can work with that. So I hope that answered your question. Awesome. Okay, perfect. All right. So, and for those of you who just joined, we've had some technical difficulties today. And I haven't seen Damien show up yet, but hey, this is a great opportunity for us to go through some more of this information. This is what we've recapped in the series to date. I'm happy to go over any of it. It gives us a great opportunity for you and I to get to know each other better, but also deep dive into all those little itty bitty questions that I have not been able to, or don't know what you have, so we can get those answered for you. All right, next question. When we invest in a syndication at the end of our hold period, when the asset is sold, can we put our investor proceeds into another investment by 1031 exchange to defer the tax liability? Awesome question. So how we work and vet our operators is that one of the criteria that we vet our operators by is that if they have the full intention to do a 1031 exchange at the sale of the asset. Okay, now that doesn't mean that they can do it, right? If we were selling an asset right now in this COVID environment, we would not be able to do a 1031 exchange very easily because there's just not that much inventory that's selling. And we can go into why that is. But anyways, we want to make sure, if that's a concern for you, I would make sure that you are partnering with an operator that has that intention, first of all. That's part of your interviewing criteria of the operator. So when we get to the end, and if we are able to do 1031 exchange, yes, but all your capital and all your gains must stay in the LLC and move forward. So it's not like you get to pull your, say you invested $50,000 and we turned it into $100,000. Part of that was distributed to you via cash flow. The other part of it stays in as capital gains. The original 50K and the capital gains would stay together in the LLC and move forward into the next deal. Okay, that could happen in a 1031 exchange. And it only means that 60 to 65% in the LLC has to stay together. So that's kind of a huge perk. So even you can make that decision at the end, game time decision. You don't have to make that decision right now if you're going to 1031. Okay, I'm going to take a big breath and take a drink of water because there's something cool here in the middle that you want to know about. Okay, so in the middle, one thing that if you're talking to operators that you would want to understand is, do they have the intention to do a refinance too, right? So with us, we have a value add strategy where we're rehabbing the units cosmetically, we're reworking the profit and loss statement, and then we're also adding additional streams of income to push up that net operating income on the asset. when we do that, we push the value on the asset where we are essentially pretty much done with our business plan somewhere between 2.5 to 3 years. And now we're waiting for the market to be favorable for us to sell. Now, one thing that we will do is we will try to do either a refinance or supplemental loan. What that allows us to do is to pull out capital from the project tax-free. So it's not a return on investment, it's a return of investment. And whenever we can pull capital out through that refinance or supplemental loan, however it works out for us, and we can give it back to our investors, now you got that tax rate. It's not in the 1031 exchange, it's been removed. And now you can go earn income in 2 places. So that's super cool. So that would be another thing I would ask. If an operator isn't doing a 1031 exchange, what are their intents to do some sort of supplemental loan or refinance anywhere in their business plan and return capital tax-free? So I hope that was helpful. All right. So what other questions do you guys have? Jump over to the chat box. This is an amazing time for us to kind of go through all these different topics that we've covered, recap anything that you may not have understood, or dive into questions that I haven't covered yet. All right, next question. Are there reasons why an operator would not refinance during the hold period? Yeah, absolutely. One, maybe the market doesn't allow it. Okay, right now, tough time to kind of get a refinance or a supplemental loan done, just purely because of the lending environment, okay? 2, maybe cap rates have gone up, okay? So when we are evaluating, determining the value of a multifamily asset, it is determined, the value is determined on net operating income divided by the cap rate, okay? So if the cap rate is going down, say from 4.5 to 4, the asset value goes up. If the cap rate goes from 4.5 to 5, then the asset value, we don't have as high of a value, okay? We still probably are beating our business plan because we are adding so many dollars to the net operating income line, okay? So even if the cap rates float up a half point or full point, we've stress tested our assets to know that as long as we continue to add dollars to that bottom line, we are preserving capital and creating forced appreciation. Okay, now we have to balance out the cost of the refinance. It costs about 1 to 2% of the loan value on the property, or total loan value on the property, first and second, okay, senior debt and mezzanine debt, to complete a refinance. Okay, so we have to weigh that cost in, all right? Also, another reason, this isn't the case with us because we're doing a value add plan, but there might be an operator that just wants to buy the asset and hold it, and they're not doing anything to force the net operating income on the property. So if they're not increasing the value and the cap rate's going up, there's no room to do a refinance, okay? So we've got some moving pieces there that we have to take into consideration. However, it's to everyone's benefit to pull out as much capital as you can before you sell, okay? So the reason why our pro formas are 5 years is that when we do that refinance at about 2.5, 3 years, then we have to kind of season the title a little bit, season the loan, and then we can sell. So, or one last situation is if we get to the point where we want to refinance, we've completed the business plan, we're looking at a refinance, and the market's actually that great that we can deliver our return to our investors and say at year 3 and not have to wait until year 5. That creates velocity of money too. So we would skip the refinance and go for the sale. All right, what other questions do you guys have? And for those of you who just joined in, I just admitted a couple additional people into here. We had some technical difficulties today. It looks like I'm not gonna be able to get Damien on here. We will get him rescheduled, I promise. But we are doing some quick Q&A over this whole series that we've been doing. Again, 410 is a conservative investing, the 3 ways you can control the investment. Underwriting, hey, if we want to break out a deal and start underwriting it, we can do that right now. Going through the capital stack, how we can mitigate risk, the tax factors, and also we've we've gotten into some questions related to how to fund the deal as well. So jump over to your chat box, make sure to drop in any questions that you might have. This is your opportunity to get them answered. All right, another question. Who are the potential buyers for your investments? Okay, so for us specifically with Goodegg Investments, we are targeting a very specific market. So we are looking at a value add B-class asset of 175 units or more. Majority of our properties are like 200 units or more. And why is that? Because we're thinking with the end in mind, okay? Are they single operators or institutional operators? It's funny enough that we are oftentimes selling back to, not to the same seller, but we're selling back to the same institution that we bought the deal from. So we will sell back to banks, retirement accounts, insurance policies. A couple of our assets have been rolled into a REIT. And this is with our operators, them repositioning their assets. It could go back to an institutional buyer. So when we are buying, we are actually buying from some of these organizations, other syndicators as well, because the asset or developers is another big one. We have 3 assets that we've picked up directly from a developer. So they've done their business plan and they're now moving on to give it to us so we can kind of like make it beautiful, more of a class A, very little CapEx and maintenance. And then we sell it to these more institutional buyers who are, their business plan is to have something that is completely rehabbed, you know, totally tenanted, you know, the whole business plan, value add plan has been completed and they just can kind of sit on for another 10, 15 years as part of their portfolio and just earn cash flow. They're, those type of institutional buyers don't want to get into rehabs at all or value adds. That's just not their thing. That's not in their business plan. All right. What other questions do you guys have? Jump over in that chat box. Another opportunity for us could be to dive into a underwrite another deal. Would you guys want to do that? Woohoo! You're talking my language, Samir. Let's underwrite a deal. Okay, so let me pull one up. Give me just a moment. So I am going to pull up one that we actually took a look at. Okay, so this is Carrington at Briar Creek. This is an asset that's closed and in our portfolio. Okay, so let's do this. Before we dive in there, I want to make sure that we have taken a look at our underwriting criteria. So let me kind of scroll down in here, and we are going to take a quick look at our underwriting criteria. Okay, now this is my criteria. Feel free to kind of use this if you want, but this is very specific to how to underwrite a value add B class asset. Okay, so not all this criteria is going to translate to mobile home parks or self-storage or C class or A class. So this is kind of my decision-making grid. All right, so when I'm looking for a value add B class asset, I'm looking at the asset class, okay? B or C, I like that, right? The market is compressing on this on B's specifically. When the market's on the upswing, People in the C class are floating up to B. When the market's on the downswing, we actually see a lot of people living in A class asset compressing on B. They are still in great locations, close to good amenities, in great school districts, okay? And the way we rehab our properties, they actually have a very A-class feel to them, okay? So that's very ideal. I like 100 units or more. We've got scale there that we can achieve our business plan with, okay? I'm looking for an equity multiple of 2x, meaning if I invest $50,000, I want in 5 years, in a 5-year hold, I want to double it to $100,000, okay? A little above, a little below, cool, but I'm losing off of velocity of money if I go too low on that. Internal rate of return. So I want between my cash flow and the gains on the back end, I want to get 16% or higher. And these two mathematically, the equity multiple and the IRR are very tied closely together, right? When I underwrite, I want to look for non-recourse debt, maybe Fannie or Freddie, okay, government-backed loan. That's what we call agency debt. And most specifically, I want to have the loan term as at least as long as the hold, all right? So if I have a 5-year hold, I would like that interest rate fixed for as long as possible, or the option to continue to purchase a fixed rate, okay? And so we'll take a look at that. Reversion cap rate. I would like to see a reversion cap rate of 10 basis points for every year of hold. So if my hold is 5 years, I would like to see a 0.5% reversion cap rate above the entry cap rate. So if the entry cap rate is 4%, I would want to see the reversion cap rate at 4.5, okay? Why? Why do we want to make sure that our operator is always underwriting on a reversion cap rate? Because we don't want to get rose-colored glasses. We want to assume the market's going to be worse upon exit, not better, okay? So that is very conservative underwriting for us. All right, market rental comps. This, if you're kind of, pulling back from, single family investing, if you're very seasoned in that respect, we want to make sure that there are several comps in the area that are higher than our property. We don't want to go in and be the best kid on the block already. We want to build up to that, and we want to see there's some space for us. So rental comps, we also want to see rental growth, and we also want to make sure that there's sales comps above us as well. All right, projected vacancy. This one's a tricky one. Very rarely do I see operators underwriting a vacancy of 10%, okay? Or previously, I haven't seen that happen. Usually they're underwriting a projected vacancy of around 5%. That said, I would see if you're underwriting a deal right now in this COVID environment, I would want to understand that at least for the next year, year and a half, maybe even 2, that they're projecting higher vacancy. And that may not be physical vacancy, but economic vacancy, right? So we want to make sure that, again, our operators aren't looking through the lens of rose-colored glasses, but right now, they're actually kind of bumping up their vacancy standards. All right, so this is our underwriting criteria, all right? Any questions on the criteria before we apply it to a deal? All right, okay. I'm gonna take silence in the chat box as we are good to go. Rent growth less than 3% equals 2.1, yeah, 2.9, sure. Yeah, so rent growth right now, I think is going to be hard to achieve in this market. So, again, we don't want to have our operator looking with rose-colored glasses. You might see performance right now where there's 0 rent growth for a year. Okay. Now, it doesn't mean they're not going to get it. It just means that they are putting in their pro forma at very conservative terms. Okay. So we don't want an operator going, hey, I'm going to get 5% rent growth or 10% rent growth. if I do, that's great and all, but remember, I want to ask why they feel like they can get that. What's going to happen in a recessionary environment? And what are they, have they stress tested their asset to make sure that if they don't get that rent growth, that the asset or the business plan still works? Okay. Do you refer to physical or economic vacancy? So vacancy is vacancy. On the pro forma, you're going to see vacancy underwritten as physical vacancy, and then economic vacancy underwritten as bad debt. Okay. Now, some operators will collapse the two line items because they think, because if the bad debt, if they actually have bad debt, they're going to get rid of it. They're going to evict the tenant, and therefore it becomes physically vacant. Okay, so we just want to make sure that between those two line items that they're actually given some cushion there. Okay. All right. And then, oh, sorry to go, Samir, go back to your question. Rent growth would have varied by market and by deal. So, you know, but again, we want to see conservative numbers, right? This is the time to hit a base hit. And if the deal knocks it out of the park, it knocks it out of the park. I want to underpromise and overdeliver, essentially, is what I'm trying to get at. All right. So let's take a look at our deal here. It's Carrington and Briar Creek. This is an asset in Raleigh, North Carolina. All right, very, very beautiful asset. So the first part of the investment summary, this is a typical table of contents that you have. Executive summary, investment highlights, overview, financial analysis, and market overview. But I'm going to show you the few different ways that you can kind of pick apart in an investment summary. So right here, remember, if we go back to our underwriting criteria, we wanted to see what? How much of a reversion cap rate? You guys go to the chat box. This is quiz time. How much of a reversion cap rate? 0.5%. Thank you. Yes. Okay, so here we have 0.86 or 4.86 and then reversion cap rate of 5.36. Okay, now that just means the financial model that they are showing you in the pro forma is calculated on a reversion cap rate of 0.5. The operator has done far more extensive analysis than just that. They will have underwritten probably what we call a sensitivity analysis and stress test to 1% more or 1% under, okay? Great, if this went from 4.86 to 3.86, we're all doing the happy dance because that property is just like cranking, the area is cranking. But we want to know conservatively, remember, if we go back to those four core tenets of conservative investing, our number one objective is to preserve capital. So I want to know that underwriting when the cap rate goes up, okay? I want to know what my returns are going to be, what is it, and what I can expect. And I want to make sure that they have underwritten for that cap rate going up. Okay, expense ratio. Okay, this is where they take the T12 and they're looking at, you know, the income to expenses. 39%, that's fantastic, but we need to actually look at the pro forma to double check those numbers. Debt service coverage ratio. Okay, this is how, what ratio the actual income on the property covers all the debt. Okay, this is 1.32. Again, that's pretty solid. Based on the debt service coverage ratio, we could probably assume that this is a loan to value of about 70%. All right, here's our purchase price, our hold time's 5 years, the raise that they're doing. Okay, equity multiple. What are we targeting right now? What did I show you? Jump in the chat box. 2x, okay. So this means, this is about 2, that if I invested $50,000, the pro forma is showing a good best case scenario that I can, well, not a best case scenario, a good chance of me doubling my money in 5 years, okay, between cash flow and capital gains. So over the course of 5 years, between the distributions I get and the added gain on the back end, I can expect to walk away with another $50,000 on top of what I have, okay? Again, creating that velocity of money. Okay, Average cash on cash return is 8.1%. Very careful. This does not mean this is what you're getting paid every month. Okay, this is not the preferred return. We got to find it someplace else. This is the average cash on cash over the life of the asset. Okay, and then we have our average annual return. That one's fine and dandy and all, but I'm looking for this internal rate of return to be about 14% or higher, because again, this correlates very well to the underwriting of a 2x multiple. All right. So the next part of the executive summary is just going to go through, location, just recap what the value add opportunity is here. Our value add opportunities on this project are to renovate, do a cosmetic rehab on the property, rework the profit and loss statement to bring down our expenses, and then also add additional streams of income. Okay. When I increase my income, decrease my expenses, and add income, I can actually pull that huge lever on the net operating income and increase the value of the asset. So if I can, I want to look through their performance and see if they're hitting all three of those buckets. Okay. Let's see, they'll secure an 80% loan from a private lender. Okay. Initial term of the loan is 3 years with 2 one-year options to extend. Okay. What do you guys think? Is this good loan terms or bad or neutral? Jump in the chat box. Let me know. Let's get your opinion. Ooh, radio silence. Okay. So when we go back to our underwriting criteria on our loan, we want to make sure that the neutral, yes, I mean neutral, because we want to make sure that actually the fixed interest rate covers the equity, the hold period, which is 5 years. So if we were filling this out as a grid, we would check it. It's still good, right? Still good, but it's not in this ideal bucket, but it's still good, all right? So this is also on this, it's a private lender, okay? We need to dig further and understand if it's a recourse loan or a non-recourse loan, all right? Below market rents, we have a rent premium here of $258. That's awesome. Okay, I love seeing that. Okay. This also gives you a breakdown of the partnership structure. Okay, remember I said right here, this 8.1%. Okay, that's not the cash on cash, that's the average cash on cash on the life of the project. What most investors like you guys are most interested in is this number right here, the preferred return. Okay. So this is what we can expect, or you could expect, if you say, we're going to do easy math here, if you invested $100,000 over a year, you could generate a dividend coupon coming back to you of $7,000. Okay. Now you go, hey, Whitney, that's not 8%. How did we get here? Well, I'll show you in a second. But on all of our projects, we look to reevaluate the project at the end of the year. And if we're meeting and beating our pro forma, we will distribute to what we projected on the pro forma. So here, year one, we are projecting 7%. So at the end of the year, we reevaluate. We're just going to keep that 7% in year two. At the end of year two, we hit 7%. We're beating our pro forma. Then we would look to distribute an additional 0.5% cash back to the investors, or maybe a little bit more. Year three, 8.2, maybe we're paying out 7% for the year. At the end of the year, we reevaluate. Now we're distributing 1.2 back to the investors. And again, year four, 1.5 at the end of the year. And then we were getting, you see 168, that's not a typo, that takes into account the sale of the property. Okay. This is a bridge loan. This is actually, it's with a private lender. We are actually keeping this in place until we will probably look to do a refinance later on in a supplemental loan in order to pull capital out. But this is a fixed rate loan, an amortized fixed rate loan. A bridge loan would be more We don't do bridge loans on our property or any of our investments. So a standard bridge loan. So what we are, you know, what I consider that to check that box is that you're going in with kind of like a hard money loan in order to rehab the property, okay, at very high interest rate terms, okay, and maybe doing a primary, okay, senior debt position and also a mezzanine debt. Yes, the terms on it, we do interest only on our loans. So, and why would we do that? Because if we start paying because our business plan is to sell and not hold the property for long term, we don't want to add additional equity into the property because the equity in the property is then locked up, okay? Our business plan is to deliver cash flow back to our investors and then also an equity position at the end. So, all right. And then, you know, you can go through the investment offering. Again, this is a 270 unit property. It's a B class, okay? 2003 year build. This is very important. I would put this on your underwriting list right now. Occupancy. What is the current occupancy on the building? And most importantly, ask the operator what the break-even occupancy is on the project. This one, it was just about 65%. So we'd have to see a physical or economic vacancy of 32% before we can no longer use rents to cover our expenses. Okay, so that gives us a large room to play with. I'm seeing deals out there right now where the occupancy, physical and economic vacancy is about 10%, and that the break-even occupancy is right around just 72. That doesn't give you much to play with, you know, should something happen, especially in this environment. So again, we lean more conservative. Our last deal that we closed in May, the break-even occupancy on it was 55%, and the current occupancy when we closed was at 98%. So we're looking to hit some like great deals that way. All right. So this investment highlights, this just kind of gives you an overall view of the business plan. When you say break-even point, does that also include being able to cover distributions? No, it does not. Okay, so that is a good, I'm gonna go back into the capital stack a little bit here because I wanna show you, because you got, I think something that's confusing sometimes for investors is that they think that they're coming in on the debt side. They're actually coming in on the equity side. So we are partnered on the equity side of the deal. Okay, so if the deal's paying, we're in it together. If the deal's not paying, we're in it together. So I'll touch on the capital stack so you understand where people lie in the deal. Our investors are in what we call the preferred equity, and they share a piece in the common equity. So meaning our investors do get paid before the GP does. So in the common equity piece. Okay, but I'll do a quick recap of that equity stack. All right, so just scrolling through the investment, you can just go through and you can see, you know, how our summary breaks down. Again, we want to make sure that we're achieving some sort of rent premiums. There's a nice cushion there. We're also underwriting the market. Remember, we went through all of our market underwriting. Okay, we want to make sure businesses are, that jobs are growing, incomes are growing. The jobs are diverse. Okay, right now I wouldn't invest in a market that is heavily reliant on hospitality or gaming right now, or travel. Those are kind of, you know, markets right now that are taking a really big hits. Okay, but this gives you an overview of that, right? And I always encourage our investors, we do a ton of due diligence on these deals before we put them out to our investors, but you should always double check numbers, right? Because at the end of the day, that's one way you get to take back control. Okay, we're gonna cruise through here because we're gonna get to the property overview. Okay, so this gives us the property overview. Okay, the different amenities on the property, unit features, and then also what we're looking to do with the property. Okay, so this is important. You know, we're looking to take kitchens and bathrooms are huge cosmetic rehabs for us. So we're looking to take kitchens from this to that. Okay. All right. You want to see good unit mixture, right? We don't want to see all 1-1s or all 2-1s. Okay. We want to see that the property has the ability for somebody to continue to expand their life and they just stay in the one place. Okay. So we want to see a good unit mixture, nice site layout. Okay. And then this is probably what you guys are most interested in is the financial analysis. Okay. All right. So also prepayment penalties. We want to know that we can sell the property. Okay. That we're not going to get caught in a situation where we should sell, but we can't because we have this massive prepayment penalty on the property and we can't get out of the loan. Prepayment penalties for like a 1 year, maybe 2, I'm not so concerned with. But if you have a prepayment penalty of like 3, 4, 5 years, that's a problem. That means we have to wait. We've got too many things that are converging at that 5-year mark that doesn't give us much flexibility. And the cool thing about this loan is that it can be assumed. All right, we can actually the buyer can actually purchase the loan with an assumption fee. Okay, we got a recap of our terms here, recap of our investor returns down here. Okay, debt and cash flow. All right, but this is what we're looking at here, return from cash flow. Okay, so this gives you a different view. This is total annual return. This is returns from cash flow. So you can take a look to see how they're different there. All right, here's your pro forma projections. Okay, we also want to make sure that they're keeping loss to lease in. Okay, that they're not getting rose-colored glasses and removing that saying my unit is never going to be vacant, that there's never going to be bad debt on the property. Okay, and then you just want to make sure all these are in line, that your expenses are staying at least 30%. Okay, because we want to see money going back into the property to improve it and keep it occupied. I've seen some performance where they're driving expenses so low down to 25, 20%. And I'm like, how are you executing the business plan? All right, and then this gives you the rental comps. This should also be a rental comp analysis. Okay, again, Carrington and Briar Creek, you can see right here in the middle, we are not the most expensive kid on the block as far as rents, okay, for the different property sizes. And then also that we're not the most expensive kid on the block as far as purchase, okay? So we got some wiggle room there. This is the sensitivity analysis. Remember, right, like a reversion cap rate, right? We're going from a 4.86 up to a 5.36. These are the different reversion cap rates. Even if we went up to 6%, our investors are still earning an internal rate of return of 11.6%, which is better than the market, okay? Here's a good breakdown of the debt service on the property. Again, we stress tested this. If our occupancy falls down to 67%, our gross income can cover the expenses. So you want to see those two analyses, okay? Cap rate analysis and the break-even occupancy. So make sure you take a look at those. All right, and then you'll have a nice view of the market. All right, there's tons of data on here on the market. So I'm going to jump back to questions right now. What happens in case we refinance the deal, proceeds are given back to the investor, and we continue to hold the property? Do you get additional return based on disposition of the asset? So the way we structure our deals, when we leave our investors in as if they were fully invested. So last April, we had a property that refinanced. We did a 20% supplemental loan. We returned 20% in the capital back to our investors. So if you were invested at $100,000, you got $20,000 back in April to go invest in another property, okay? Now, but you're still left in your investment as if you were invested at $100,000, okay? So that's pretty cool. We're not removing our investors from the deal because our business plan is to sell the property, okay? Our business plan is not to refinance and get our investors out and then we stay in, okay? Yeah, go ahead. Throw your questions in the chat box. That's totally fine. I will get to the ones that I can, so no need to wait on me. Anyways, so that is, I hope that answers your question. Let's see, debt service coverage ratio means that the property generates 130% of the cost of the debt of the asset. Yes, covers 130% of the debt on the asset. Okay, not generates 100%, 130% of the cost. Well, I mean, maybe we're saying the same thing, but it covers 130% of the debt on the property. Yes. Let's see here. Let's jump back over to our capital stack. So this is the general capital stack. And the reason why I'm coming back here, there was a couple questions on if, say, occupancy drops, you know, is the distribution back to the investor considered essentially a bill and calculated in as far as the debt on the property? No. Why? Well, because the investor, the limited partner, falls here. They're split between the preferred equity piece and the common equity. Okay, so they're not debt. Okay, I'm a limited partner on a lot of deals, and I'm not doing a second loan for those deals. Okay, so I'm not on the debt side. I'm on the equity side. Now, it's preferred equity, meaning if I have a 7% preferred return, the general partner is not making anything until I get made whole on my 7%. Okay, so just want to make sure that everybody understands that. And then once I'm made whole on my 7%, and we go to sell the property, I'm splitting the capital gains 70-30 with the general partner. Okay, so we are both sharing in the common equity. Let's see, here's a look at a single tiered stack. There's a couple different ways to do the stack, where we're doing our senior, senior debt is at, say, 70% LTV. And then the common equity class A, which would be our preferred equity class, gets 70%. And then the common equity class B, which is the general partner, they get 30%. So this just kind of gives you an understanding of who gets higher priority when money starts coming in, and then who has the risk tolerance. So the senior debt has the lowest risk position. Common equity A in the middle, and then common equity B has the highest risk position. We'll do a two-tier stack. This just gives you a little bit of, options to of how you might want to break down returns coming to you. But we think of this preferred equity class A as being the mezzanine loan, okay? But they're not on debt, they're still equity. So right here, that preferred A would operate like a mezzanine debt situation, but it's equity, not debt, okay? And then say like this pays out, you have your senior debt, which is your loan, and then we would raise preferred equity class A, which say they get paid 10% return. On our last deal, they got paid a 10%, or excuse me, 9% preferred return, but that's it. They don't get to share in the common equity class, okay? That's it. They're getting a 9% coupon for the duration of the hold. And then for class B, they get a 7% preferred return, but they also get to share a 70-30 split on the back end of the deal when the deal sells. Okay, so those are a couple different ways that we can structure our deals, and it just gives you a little bit of flexibility on how you would like to invest in the deal. Some people just want to just get straight cash flow month to month. Okay, some people want to have, or excuse me, they want higher cash flow month to month, but they don't care about the equity on the back end. Some people want to have, are okay with a lower cash flow to get more equity on the back end. All right. Go ahead, you guys, we just have a couple more minutes. Jump in the chat box. I want to make sure that we get your questions answered. This is, again, a unique opportunity for us to kind of like recap all, catch up on all the things that we've been doing for the past few weeks. Oh, yeah, the break even. Let's go. Okay, so the question is, could you explain how break even is calculated for Carrington sensitivity analysis? So let's go back up here. So our sensitivity analysis. So at our current rental profile, okay, so I don't have that number right in front of me, but our current income profile, let's go back up here. a current income coming in at 708, 710, that once we paid, and that's monthly, right? So gross income, if we drop down to 67%, assuming our current profile, we would go from generating 4.9 million a year down to 3.7 million a year. And that would actually still cover our total expenses on the property. So principal, interest, taxes, insurance, any other sort of HOA, and that's, and I believe they put in agency debt will also put in reserve maintenance, and then also property management. Okay, so all other expenses, CapEx, maintenance, we get to kind of pull the levers on those, so we don't exactly have to, they're not accounted in the debt service expense. Okay. So, but that's good to know that, again, we could have something huge happen on the property and over 30% vacate, and we still can cover all the bills and the assets preserved, your capital is preserved, right? We want to see that cushion. All right, how do you manage to renovate all the units of an apartment complex within 3 years? That is, how can you guarantee all the units will be vacant during a 2 to 3 year period and your rehab team will have the opportunity to gain access to the units? So we do it on a rolling basis. So, as you can see, no property is fully occupied at the time, that you purchase. So we're going to start with those units and start our rehab process. And then as leases renew over the course of the year, because generally the leases are a 1-year lease, we are going to move people around. We're going to play this kind of Tetris game of moving people around, pushing rent premiums, moving them into rehab units, okay? Because we're doing such an amazing job on the property, they don't want to leave. They're seeing the progress. They're seeing their community evolve and change, okay? A lot of people love that. So we play this Tetris game for 2 to 3 years to get people all moved around. Now, we don't actually have to, a lot of times we don't have to actually rehab 100% of the units in order to achieve our returns. Sometimes we only have to achieve, maybe rent 40 or 50% of the units, and then we've actually achieved our returns, and we go and sell the property, and we leave some meat on the bone for future investors. So not exactly every unit gets rehabbed, but we can aim for that for sure. So generally people don't mind moving units within the same complex. It's part of the business plan, and we make it easy for them to do and not say no to. Okay, so when the end of the lease is the end of the lease, we don't have to renew their lease with them. So that's part of the business plan in order to move people around. When leases renew for a resident, wouldn't they continue to stay in the same unit? How would we rehab that specific unit? We wouldn't. We would just say, we are rehabbing your unit and we have these other units available for you to take a look at and move into. And again, 95% of the time, they are so happy to move to a unit that is freshly updated and rehab. And, again, the rents are still very affordable, right? It's worthwhile for us to move them and get maybe a $60 or $70 rent premium, as opposed within the same unit. They know us, they love us, they know the amenities, they know the properties, they don't really have to switch much of anything, as opposed to them moving off-site. Okay, that's a bigger move. So again, that's kind of how we get that. All right. Well, hey guys, I got us at time. I want to thank you so much for your flexibility today and hanging with me, and we, getting to answer a lot of your questions. There were amazing questions today. I'm glad we got to dig into some, analyses and kind of pick these apart a little bit. Yes, absolutely. Thank you to you too. I will, get this up and rolling and get this out to you. As always, if you have ideas of things that you would like for me to cover, make sure, jump in the chat box right now. Don't leave. Jump in the chat box right now. Make sure you drop in your ideas there, because again, these webinars are for you. They're not for me. They're for you to make sure that you are fully educated, comfortable, and you're getting your questions answered. And if you haven't already, make sure to join our Goodegg Investor Club. You can sign up here. If you want to get on our deal flow list, you and I need to have a conversation. So make sure to go to this page, hit the goodegginvestments.com/invest, apply now, and then you can fill in an application, and then we can set up a time to talk. That is the only way that I can share deals with you. I cannot, if we have not talked, I cannot share deals with you. That's just part of the SEC requirement. So make sure to go there, jump on it, apply on the list, and we'll get you going. And we'll look forward. Yeah, absolutely. I love doing these Q&A sessions. Anyways, thank you so much for joining me today, and I will talk to you guys very soon. Have a great day. Ooh, okay.